Good day everyone. Today we will discuss about consumer loan. So before we begin, our aims for today are number 1, at the end of the lesson, student will be able to define what is consumer loan and its importance. Second, and it will be able to identify the types of consumer loans and its categories. What is a consumer loan? A consumer loan is any type of loan issued to help a consumer afford a purchase. This purchase can range from small retail purchase acquired through a payment plan to the biggest purchase you will make in your life, including your mortgage. Importance of consumer loans. Many factors have influenced the increasing growth of consumer loans, but people's inability to pay for their expenses with their income is the most significant one. Unlike in the past, where indebtedness was often disapproved, borrowing money is perfectly normal nowadays. People take out loans to purchase a home or cover tuition, travel, or renovation expenses. But besides that, through banks and alternative lenders, the government used loans to control the country's economy. Because while loans provide consumers with the opportunity to make durable assets and large expenditures, it enhances economic welfare at the same time. You might be surprised to know that economic progress has been linked with the enlargement of credit markets. To understand this better, we've discussed the important role of consumer loans in the economy below. 5 types of consumer loans. Number 1 is mortgage. A mortgage is secured loan given by a bank to a consumer for a buying house, which usually costs much more than what an average person earns in a year. This type of loan is stretched over a longer period of time to ease out monthly installments, the most common mortgage being a 30-year fixed rate loan. Second one is credit cards. It is the most commonly used and popular among the various types of consumer loans. A borrower usually uses it to buy daily need items such as groceries, apparel, and etc. on credit. The rate of interest charged on this type of loan is a bit on the higher side, and those failure to pay on time can attract a very high penalty. The third one is auto loans. An auto loan is either extended by a bank or the car dealer itself to finance the purchase of a vehicle. The term of a typical auto loans range from 2 years to 7 years. To tenor is shorter, and the down payment is larger for an auto loan due to the rapid car value depreciation. It is typically secured in nature. The fourth one is student loans. The objective of an education loan is to fulfill the education needs of a student by paying the college tuition fees. In this way, students are able to pursue their life goals through proper education. This is an unsecured type of loan, and the prepayment only starts few months after the student's graduation from college. And the last one is personal loans. A personal loan caters to various day-to-day needs of the borrower. It is the most versatile type of loan in the consumer loan market due to its wide range of in-use purposes, including the consolidation, vacations, and etc. This type of loan usually has a long tenor and can be either secured or unsecured in nature. The secured and unsecured consumer loans. First, secured consumer loans are the loans that are backed by collateral, assets that are used to cover the loan in the event that the borrower defaults. Secured loans generally grant the borrower greater amounts of financing, a longer repayment period, and a lower charge interest rate. As the loan is backed by assets, the risk faced by the lender is reduced. For example, in the event that the borrower defaults, the lender would be able to take possession of collateralized asset and liquidate them to repay the outstanding amount. Second is the unsecured consumer loans, are loans that are not backed by collateral. Unsecured loans generally grant the borrower a limited amount of financing, a shorter repayment period, and a higher charged interest rate. As the loan is not backed by assets, the lender faces increased risk. For For example, in the case of borrower default, the lender may not be able to recover the outstanding loan amount. The most important difference between a secured and unsecured loan is the collateral required to attain the loan. A secured loan requires to provide the lender with an assets that will be used as a collateral for the loan. Secured loans usually have a lower rate of interest when compared to unsecured loan. Typically, interest rates on unsecured loans are higher than rates on secured loans because the lender has a high risk level of the loan not being repaid. Unsecured loans may be difficult to obtain if you do not have much positive credit history or don't have a regular income. Two types of categories loans. Open-end loan. An open-end consumer loan, also known as revolving credit, is a loan in that the borrower can use for any type of purchase but must pay back a minimum amount of the loan, plus interest, before a specified date. Open-end loans are generally unsecured if a consumer is unable to pay off the loan in full before the specified date interest is charged. A credit card is an example of an open-end consumer loan. The consumer is able to make purchase on a credit card but must pay the outstanding amount when it becomes due. If the consumer fails to settle the outstanding amount on the credit card, he or she would be charged interest until the amount is paid off. Closed-end loan. A closed-end consumer loan, also known as an installment credit, is used to finance specific purchase. In closed-end loans, the consumer makes equal monthly payment over a period of time. Such loans are generally secured. If a consumer is unable to pay the installment amounts, the lender can seize the assets that were used as collateral. The advantage of closed-end credit is that allow a person to achieve good credit score image, provided that all the repayments are made in time. Auto loans are especially beneficial in this respect. Successful management of a closed-end credit is a very demonstrative indicator for future lenders. That would be all. Thank you.